Why was the Federal Reserve created after financial panics? Imagine a time when banks would suddenly run out of money, causing chaos and shaking the entire economy. That was the reality in the United States before the Federal Reserve was created. Back in the late 1800s and early 1900s, the country faced frequent financial crises. These were not small hiccups but full-blown panics that led to bank failures and economic downturns. People would rush to withdraw their deposits, and many banks would collapse even if they were financially healthy. These sudden bank runs created instability and made it hard for the economy to grow steadily. One of the worst crises was the Panic of 1907. During this event, many banks faced massive withdrawals, and the money supply shrank sharply. This caused a deep recession and showed just how fragile the banking system was. At that time, there was no central authority to step in and help. Banks had no way to get emergency funds quickly, which made the panic worse. Without a lender of last resort, the crisis spread faster and caused more damage. The government and banking leaders realized they needed a better system. They wanted a way to prevent these panics from happening again. The idea was to create a central bank that could provide emergency reserves to banks in trouble. This would help stop bank runs and keep the financial system stable. They also wanted a currency that could expand or shrink depending on the economy's needs, making the system more flexible. The process of creating the Federal Reserve involved many debates and studies. A key step was the Aldrich-Vreeland Act of 1900, which set up a commission to recommend reforms. The final Federal Reserve Act was passed in 1913. It created a hybrid system with a central governing board and regional reserve banks. This structure balanced public oversight with private banking interests, aiming to keep the system stable while respecting regional differences. Over time, the Federal Reserve took on more roles. It started managing the overall money supply, setting interest rates, and promoting a healthy banking system. Its main job was to act as a lender of last resort during crises, providing liquidity to prevent bank failures. This role has been tested many times, especially during the Great Depression and the financial crisis of 2007 to 2009, when the Federal Reserve stepped in to stabilize markets. In short, the Federal Reserve was created after financial panics to build a safer, more reliable banking system. It was designed to provide emergency funds, manage the money supply more effectively, and prevent the kind of chaos that had repeatedly shaken the economy. Its creation marked a turning point in how the United States handled financial stability, helping to protect millions of people from the fallout of banking crises.